In this video, we're going to have a look at the largest company in the world. We're going to have a look at Apple. Of course, they require no introduction because everybody knows what Apple is and what Apple does. They are known for the iPhone, they are known for the AirPods, they are known for the tablets, they are known for the App Store, and they are known for things like iTunes. They have a massive brand and a massive following. So let's see exactly what Apple has been up to for the past 10 years, if we can expect to beat the market in the coming 10 years. So looking at their revenue, we can see that they started at $170 billion here in 2013, which has risen all the way to about $400 billion in 2022. A massive growth when it comes to their top line revenue of about 8% every single year. Their EBITDA has also been growing quite heavily, $55 billion in 2013, $130 billion here in 2022, which I think gives me about a margin of, I want to say, about 33%. So let's see, if we take this number and we divide it by the revenue, make it a percentage point, we can see that they have a profit margin of 33% here in 2022, which I think is about the average number that we see here as well. So revenue and EBITDA are growing in line because their margins are not increasing, but overall growing about 8% every single year. Their debt level has been going up a little bit every single year by about 20%. Now, of course, we do see a pretty big spike here in 2017, but apart from that, they've been only marginally increasing their debt level. Of course, they also have quite a lot of cash on hand, so they can pretty much pay down a relatively big part of their debt level. And just looking at the straight up numbers, we notice that as well within 1 year of EBITDA, 1 year of earnings basically covers their entire debt level. So there's no risk of bankruptcy here whatsoever, which is probably a good thing for the world's largest company. Their market cap has been increasing by 13.4% every single year, and this does not include dividends and is not taken into consideration the share buybacks that Apple has been doing, which of course increases the price per share more than it increases the market cap. But nevertheless, their market cap has been increasing by well over 13%. Their enterprise value has been increasing a little bit more than that because of course they do have additional debt over this period as well, but mostly in line with their market cap. They have been trading historically at a multiple of 14.6 times, where we see a low multiple of 8.2 times here in 2015 and an absolute high multiple of 27 times in 2020. Now, I think 27 times is very high for a company with an EBITDA growth of about 8%, so I think this was definitely overvalued, but at the same time 8 times was also definitely undervalued for a stock like Apple. So I very much like the 14 times. I think it might be a little bit higher here, as we can see for the past 3 years. They have been a staple of stability in the American stock market, so I think that definitely deserves a premium. Net debt to EBITDA level, there's not much to say there. They don't have really much debt to speak of, so of course their multiple is well within the 3 times ratio that we always use to estimate a safe or unsafe investment. So no risk of bankruptcy here whatsoever. Looking at their cash flow, we can see it's pretty much in line here with their EBITDA, which is very nice to see. It means that the accounting team is expending appropriately. Their cash flow has been growing in line with their EBITDA numbers. Their capital expenditure has actually been going down relative to their cash flow from operations. So cash flow has been increasing by 9%, while capital expenditure has been increasing by 3%. Now, capital expenditure is everything that they need to keep on future-proofing their business. It's the purchasing of additional locations, the purchasing of additional factories, giving a new brush of paint to some of their facilities, everything you need to keep future-proofing their business. So we can see here that they've been very conservative with their spending habits, and their capital expenditure has not been increasing all that much, which very much increases the cash flow margins here between cash flow from operations and their free cash flow, because their free cash flow has been increasing by about 9% as well. $111 billion of jack here in 2022. Now, this free cash flow flows directly to you as the equity owner. It flows directly through to you as a shareholder of Apple. And what can they do with all this money? Of course, they can buy back shares, they can pay a dividend, they can do additional acquisitions, and they can buy back debt. Now, there's not much debt to speak of, so of course most of this money goes into share buybacks as well as dividends. And that's also what we see here in the very next column. We see an average reduction of their share count of 4% every single year. Now these are insane buyback numbers for any company I've seen. I think Apple is certainly at the top 10 when it comes to their buyback levels. They give incredible returns to any investor that buys their stock. They had 25 billion shares outstanding in 2013 and they reduced that to 16 billion in 2022. A 9 billion haircut on their total share count. They basically bought these shares, ripped them up and increased the shareholder percentage ownership of the company. So the moment that you buy an Apple share, you can very much expect them to increase in value over the long term because there are less shares in circulation. So your one share will have more value in a few years than it will have right now, simply because the total pool of shares is decreasing. And of course, this also very much has a positive effect on the free cash flow per share, because not only is their free cash flow growing by 9%, they are also reducing the outstanding shares by 4% every single year. So we see a free cash flow per share increase of 14%, which is very, very attractive for any investor. The price per share as seen on the stock market has been increasing from $25 here in 2013 all the way to $138 in 2022. Now we saw here for the first 4 years they had basically no movement into their share price, even though their cash flow from operations has been increasing during this time. So this is also where we saw the relatively low multiple here in 2016 and 2015 of 8.2 times EBITDA. But of course after that we saw a massive growth spurt here in the past few years. Overall, their free cash flow yield has been around 6.5%, where I think for the past 5-6 years it's been well below this point. So this is mostly influenced by the first 3 years here. So I think the 6.5 average that we see here is no longer in line with their recent numbers as well as possibly their future numbers. So this then brings me into the business of trying to forecast Apple into the future. And we start doing this by looking at the enterprise value model. So I'm going to take here the EBITDA of 2022. And what I'm going to do here to be conservative, because whenever I make a projection, I want it to be a conservative projection. And if my conservative projection beats the stock market, that's when I'm going to be interested in buying the stock. And what we see here for their enterprise value is that their EBITDA has grown by 55% in 2021. Of course, the COVID stimulus, everyone had money to spare, everyone was just buying luxury things as much as they could, and we saw a massive top line revenue increase here for Apple. Now, I do expect some headwinds, and I do not expect them to continue this level of growth, because I think it's simply unsustainable. So I think to account for any economic headwinds that may be coming towards Apple, because of course we do see them moving some of their operations from China to India as well as back to the United States, which will of course increase the price for Apple as well as they try to restructure their supply chains. So I'm going to give them a 0% EBITDA growth here for 2023, and afterwards I'm going to grow it by 6% for the 4 years after that and 5% for the last 5 years. Historically they've been doing 8.9 on average, but of course a growth number like 55 is very much throwing a massive wrench into this calculation. And I think the moment that we normalize this a little bit more, I think what we can see is a growth more in line with about 5 to 6%. So I want to be conservative here compared to the historic average, and I'm going to say 6% and then reduce it to 5%. I'm going to attach a multiple of 17 times, which I think is higher than their historic multiple of 14.6, but I think for the past few years we can see that Apple has been trading at a premium because of its stability in the stock market, because of it being the biggest company in the world. They deserve a premium there, so I'm going to give them 17 times, which I think is the average for the last 5 years. This gives me an enterprise value 10 years from now of about $3.5 trillion, to which we subtract the debt, we add the cash, and it gives me roughly the same number. Now I'm going to divide this by the amount of shares outstanding, and I'm going to assume that the amount of shares outstanding remain the same and will not be decreased, and this gives me a stock price 10 years from now of $213. We're going to do the same here for their free cash flow model. I'm going to give Apple a 0% growth here for the first year, 6% for the 4 years after, and 5% for the last 5 years. I'm also going to attach a 5% yield, which gives me a share price of $219.97. So the moment that we look at the stock market right now, you can buy as many shares of Apple as you want for $160. If I take both my projections, I get an average share price 10 years from now of $216.15. Simply looking at the share price on the stock market itself, this gives me a compounding annual growth rate of 3.1%. But of course, we have to take into consideration their free cash flow as well as projected here in the free cash flow model. And the moment that we include all the free cash flow that we see here, we get an IRR of 8.9%. So I think looking at those numbers, I expect Apple to underperform the market. So why are so many people still buying Apple is maybe a question that you're asking. And I think that all comes down to the way that Apple is very much rewarding their shareholders, right? Because as you might have noticed and maybe wondered about as well, I kept their total outstanding shares the same, and I do not include their share buybacks into their free cash flow growth. Now, the moment that I do that, and I'm assuming that all of their free cash flow will be used to buy back shares, which they have been doing historically as well. For the most part, they've used a little bit of their capital for dividends, but mostly for share buybacks. And I think the moment that we see that and we reduce their share count by about 4%, let's say 10 years from now, they have a total outstanding share count of 12 billion shares. I get a share price for the enterprise value model of $290. Now, of course, if we also include the share buybacks into the free cash flow per share, because of course the amount of shares outstanding will decrease, which will increase the free cash flow per share because the total free cash flow will be divided on a lower amount of shares. So then we look at that historic increase in free cash flow per share and we see 14% every single year. Now I want to be a bit more conservative, of course, so I'm going to give them 12% here for the first 4 years and I'm going to give them 10% for the 5 years after that. And the moment that we take a look at these numbers, we see a whole different picture. We see a share price 10 years from now of 290 and a share price 10 years from now of 345. And if we look at our model right now, I expect a compounding annual growth rate of 7.1% simply looking at the stock market itself. Now, I do want to say that the moment that we look at these numbers, we can no longer take the IRR because the IRR, the free cash flow that we already have projected here, we use that to buy back the shares. We already use that inside of our models, so we can't use this again. So at that moment, we only see a compounding annual growth rate of 7.1%. And all the numbers that we see here for our IRR calculation will be used for share buybacks, which will be used to increase our free cash flow per share and increase our value according to the enterprise value model. But we no longer get it because we already used it inside of our models. So then we still get an IRR of about 8%. And now you might be wondering, well, that's about the same number that we had with the previous model. And that is very much true, it is. But the moment that we project the next 10 years after this, so from 2032 all the way to 2042, we can expect a much higher free cash flow than if we didn't buy back the shares. So of course, share buybacks are getting more valuable the more that time is progressing, the more that earnings are increasing over time. So that's why I think for the next 10 years, simply buying and holding Apple is not as attractive. But I think the moment that you hold it for about 40 years and they keep consistently buying back their shares and also increasing their dividends, because of course they can increase their dividends because there are less shares to pay dividends out to, we see a very much increasing hockey curve when it comes to total returns, but it does take quite a long time. Now, of course, this does assume that basically all the money that they have is being used to buy back more shares, which is not a guarantee. And that's why I don't want to use this model up front. But of course, it's something to take into consideration because it's a very big possibility that they will do that. So I think Apple is very much a stock that is fairly priced and it will probably perform in line with the market itself. But I don't expect it to outperform and I don't expect it to underperform. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!